Hi, this is Tron Welch with Welch Financial Planning, and welcome to our 2023 third quarter economic update. Should be fairly quick presentation. Just a couple points to make on where the economy is right now, which in general it's doing really well. So here's the chart that we've probably shown at every economic update that we do. And we are on a 2% growth trend, and we've been on that since like 2001. And there's really no argument that we're ever going to get off of that. And so we are, the economy is continuing to grow back to that 2%, and I expect it will. So the big drivers here that, are going to stop our growth at 2% is just kind of the diminishing productivity that is going on. And, that's been going on for a couple decades. I'm not sure what people are doing, but we're not as productive as we used to be. I do expect artificial intelligence or AI to change that upcoming to where we will get a higher productivity out of folks. But then secondarily, there are no more folks. We are not really adding to our population, whether that's through immigration or through childbirth, but we're just not adding people. I mean, you need people to grow an economy. That's historically been true and is proving true now. So I don't see a way that we would get over the 2% trend line for any material amount of time. So from here, what I really look at, there's been a lot of talk about a recession, that the Fed is going to over-tighten and put us in recession and all that. And the discussion of that is waning a little bit. And for me, I don't see a recession coming. And what is the big driver for me is labor demand. And here on this chart, the JOLTS chart, the job openings, you can see that there's close to 10 million jobs open today. So companies are basically looking for people to hire to help them produce more goods or services, and they just can't find them. So that just tells me there's just kind of a natural dampening of economic activity because there's not enough of the right people to fill those spots. And so for the economy to really go into recession, they would have to destroy so many jobs. A lot of the 10 million jobs would have to be destroyed to reduce that demand, to really get the economy into a spot of trouble. And I just don't see that happening. I think we're going to have a soft landing, and we'll just go on our merry way on the 2% trend line. So the piece that I knew this was true, but I just couldn't find the data for it, and here it is. So this is labor force participation, and the light blue line is the 25 to 54-year-olds. And you can see in 2016, they were kind of ramping up and 40% of them were working, pandemic comes. But what has happened is that younger group has come back, and now a higher percentage of them are working now than they were before the pandemic. But the piece that is really having a material impact is the 55 and over crowd. And you can see that they had equal participation in the market to the younger folks, but then post-pandemic, the 55-year-olds did not come back. There's several problems with that, as one of them is obviously the jobs that they held were probably the upper end of the corporate jobs, and they were bringing 30 years of experience. And kind of the point that I'm making on the productivity side is that your best knowledgeable workers are kind of leaving the door, and they're getting replaced with people that are 10, 15, 20 years younger than them without quite the experience with it. The other piece that's in there is that we saw a lot of retirements at Welch Financial Planning, and just about everybody 58 and up, post-pandemic came into the office and said, okay, how do I get out as quickly as possible? And a lot of that was excess pressure at work, not really seeing any wage growth, and then layoffs. We had a ton of layoffs in the office, and they all looked the same. They looked at 55 and older were the only people that laid off. I can't think of any 40-year-old employees that we have that got laid off. We don't have a ton of 40-year-olds, but those people all kept their job. So 55-year-olds have left the marketplace. Unemployment and wages, this is a really interesting chart, and it's behaving differently than what it has in the past. And we see that unemployment, which is the black line, really spiked in 2020, COVID, we get that. And then it has come back down, below the historical trend of 4%. So unemployment is back down to historically low amounts. But what is interesting is that you're also seeing wage growth declining even though unemployment is so low. And that is kind of a new function of whatever, how this economy presents itself, is that employers are really wage sensitive at this time. They're not really giving out big money for people. So this graph basically says all you need to know about the federal fund rate and inflation. This is a wonderful keep it simple chart. So you've got the blue being the inflation. You can see the inflation, kind of spiking in 2022. And then the federal funds starting to raise rates at that time. And as interest rates represented in the black increases, inflation came down. Just textbook solution there. This has got to be one of the cleanest scenarios that you can see of rising interest rates and declining inflation. So inflation is definitely coming down. Money value, M2. So this is a little bit higher level economics. M2, you can think of that as the money supply. That's your checking account, your savings account, short-term deposits. And in 2020, when the stimulus was just creating cash all over the place, we can see now in 2022, it's kind of tipped over. And now M2 supply, or just cash laying around, is declining. And that is also helping bring inflation down, of which the offset of that is the higher interest rates are probably playing a part of that. So this is a global economic activity momentum chart. Red is bad, green is good. It's also called the heat map. So, you can kind of see pre-pandemic and the pandemic, the economy, hitting red basically top to bottom. And then again, some slowdown in 2022 where there's a lot of yellow and a lot of red in that line. And now when you go to the back end of the most recent corner, you can kind of see that it is greening. And so it's fair to say that the world economy is certainly strengthening, getting its feet going and moving forward. So from here, I do want to talk a little bit about interest rates. We're not expecting a large increase from here, if any. So there's three different projections on here, or two that we're going to talk about. You can see that the federal funds rate in the solid black line, spiking starting in 2021. And you can kind of see how aggressively and quickly they did raise rates. But from here is really the question. So the Fed is signaling that they may raise rates one more time, from 5.25% to 5.6% or something in that. But the market, meaning the bond traders and the financial gurus running around Wall Street, are basically saying that we're done with the interest rates. They don't believe that the Feds will raise interest rates again, and that interest rates will actually start declining in 2023 through 2025. So for those of you that bought a house recently or purchased a car recently that you financed, you should be able to maybe refi those in a couple of years at a lower rate. So interest rates, there's a lot of evidence out there that interest rates will come down in the near future. Growth rate of China, I think this is just kind of worth discussing. China is now, is the second largest economy in the world, kind of catching up to us. And so we should probably be paying a little bit more attention to it. Obviously, there's a lot of political tension between the two countries at this time. I think there's some effort to kind of tamper that down. But you can't get the toothpaste back into the tube overnight. But the point of this slide is just kind of showing that China is also in a downward trend of economic growth. In the early 2010s through 2019, they were kind of going from an 8% rate down to a 6% rate. But post-COVID, they came out of the gate at basically at a 4% rate, and they're declining down to 3.5%, and they'll probably hit 3% moving forward. So it wouldn't surprise me if China was trending at a 3% growth rate while we were trending at 2% for the next 5 to 10 years. So inflation in China, they didn't see the inflation numbers that we did, and now they're back on a 2% trend moving forward. So the inflation fears of China are set. The economic issues that China are facing are more the consumer. They're not quite as good as consumers as we are, which shouldn't surprise anybody. That as soon as we get a couple nickels in our pocket, man, we're spending them and tossing them out. China consumers are hanging on to money a little bit better than we do, which was hampering their economy and keeping kind of inflation naturally low. So I believe that is it for today. Thank you very much for the presentation. The big takeaways are inflation is getting put back in the box. We're going to get on the 2% trend line, and unemployment should stay low for the foreseeable future. Thank you for your time. If you have any questions or comments, feel free to give a call. Bye-bye.